Second.
This meeting is being recorded.
Okay, we're live.
Okay, welcome to the first Council of Revenues meeting of 2022. Happy New Year to everyone. Okay, first item is, are there any communications to the council or any public comment?
We have not received any.
Sid, how do you know if someone like writes in a message? Are we
Yeah,
checking?
they
like
can, in fact, everybody who, and we can just take a couple minutes. Anybody who wants to ask a question or submit official things can do it through the question and answer session. And then if they want to do it in live version, we'll just invite them in to participate. Participate as a panelist momentarily. So anybody who would like to make some public comment right now can do so through the question and answer session.
I don't see any questions or chats yet.
Yeah.
Okay. Next item on the agenda is the minutes from the personal income meeting on November 2nd, 2021.
Move to approve.
Second.
Okay, any comments before we take the vote? Okay, Vice Chair Newell,
Yes.
Dr. Siderhoff,
Yes.
Dr. Bonham,
Yes.
Councilmember Miller,
Yes.
Councilmember Hayashi,
Yes.
Councilmember Lee,
Yes.
and so it's unanimously approved. Okay, next item, we're very fortunate today to have the director who's going to give us a presentation on his revenue enhancement initiatives. So I'd like to turn it over to the director, Isaac Choi.
Okay, good afternoon, everybody. I did read on your agenda that you wanted me to talk about revenue enhancements. I'm sure you folks all know the term revenue enhancements at the legislature is a code word for tax increases. So no, I do not have any revenue enhancement initiatives coming out of the tax department, but I believe what you're trying to ask me is, am I doing anything special that's spiking the revenues to go up? As we all know, people pay voluntarily, and I don't know how much influence I have over the increase in revenues. If you guys want to give credit to me, I'll take it. But I think I don't have that much influence. Anything special I do, maybe I comb my hair better and brush my teeth, and maybe that will enhance revenues. But I can't take any type of long-term credit for the spike in revenues that we have. We all know that the stimulus programs are spiking our income tax, and that's probably the #1 cause for our spike in revenues. But I can't tell you any specific program of, and as you folks know, audit or compliance measures that I do. But things like the vacation rentals is very, very popular in the paper, so I can at least disclose that. We're very, very aggressive in that particular area. We will be until we finally get the kind of compliance that we want. You folks all know that voluntary compliance of taxes is what the department aims for. And all these compliance initiatives that we do, like vacation rentals, hopefully adds to the total compliance picture. We feel, and I think Dr. Kobe can back me up on, that we do have the majority of taxpayers, and I'm talking about 93-94% voluntary compliance. At the department, we have tried to measure tax gap and the amount of non-compliance we have. I remember during Kurt's term as director, he's told me the tax gap was 350 million. I never believed him. I think it's about $1 billion.
Oh, so you think I was way too low then?
Yeah, I thought you were underestimating that.
Yeah.
But besides vacation rentals, the legislature was kind enough to put a $65 million computer into our department. And those mechanical processes like matching returns or matching data from the Internal Revenue Service is done pretty efficiently now. And those mechanical processes obviously enables us to contact taxpayers via letter or phone call that we can remind them that either they made an error on their return or they did not get a return. I think if you ever use our system today, you'll be getting more communications from the tax office on little errors that you made faster than you guys ever thought of in your life. So we do things like that. Your bigger audits, your bigger compliance initiatives does come from this organization called the Multi-State Tax Commission. I think they do an adequate job. I don't think they do an outstanding job of getting all the big companies, your favorite companies like Microsoft or Intel or Amazon or Home Depot, and I guess I can name all. These are just random big names. They do have compliance initiatives every single year that we participate in. I think we take all the initiatives from the Multi-State Tax Commission and we follow through on those, and those are revenue generators or enhancements or compliance measures that are done on a very, very big basis. I like to take pride in some of the other local initiatives that I've taken, reaching out to the local practitioners, making sure that we have a good line of communications. Like I said, the majority of taxpayers are good taxpayers. They're voluntary comply. And of course, the local practitioners, we have real good local practitioners. And if we can give them the tools and the service to allow them to service their clients, and that's one of my initiatives, to have the lines of communications open with these guys, they will help us with all types of compliance measures. So that's something that we're very, very proud of. I don't know, Kurt. I mean, we do go after. So let me at least tell you my particular philosophy. As you know, and Dr. Kobe has informed me that the amount of business, I should say, that's done by companies without physical presence in Hawaii has grown exponentially and has grown even more exponentially because of the pandemic. At the department here, and you folks can kind of imagine how hard it is to go and try to make sure that they're in total compliance with our tax law. And we do have a very, very unique tax, right, called a GET. A lot of people don't understand that. So at the department here, we are now beginning different initiatives to make sure that these people comply with our laws. First, I'm not saying that they're not paying the right amount, but they may be misunderstanding our laws. And of course, trying to go after them is a monumental tax. It takes a lot of training of our personnel and of course, cooperation by them to pay the right amount of tax. So that's another initiative that I think is going to be very, very fruitful in the future. And overall, the cheapest way of collecting taxes is voluntary compliance. So we do stress that, and our taxpayer services section bends over backwards to make sure that we service our good taxpayers. And as I said, we even have a program where Kurt is always in, where he voluntarily brings his bad clients to us and tries to negotiate a good deal with us, and he's pretty successful. And we have a voluntary disclosure program that's really, really good. So the mantra here is, if you're going to come forward and voluntarily disclose any kind of shortfall that you may have or any kind of problems you're having paying your taxes, if you're going to come forward, of course, we're going to bend over backwards. And I said it the other day in my WAM presentation that we're probably the friendliest people if you're coming forward voluntarily. But again, if I have to come and get you, you're not going to like that particular experience. So Kurt, those, as you know, those are it's just a philosophy in compliance. We've changed our model in the department, right? To make sure that people know we're protecting the revenues of the state, making sure that everybody pays their fair share, for the good of the good taxpayers, just to be equitable. If somebody has to pay, then everybody's got to pay. So we've changed our attitude in this department, and I think we're a lot more aggressive. Hopefully, all these things adds to the revenue picture that you folks are trying to guess at. So with that, I'll answer any questions that I can.
Scott, Councilmember Hayashi.
Director, thanks for that presentation. One of the questions I have is there any initiatives or thoughts about remote workers? We've been hearing a lot about, people coming to Hawaii, setting up camp, working for a company on the mainland. I'm not sure how, I'm sure it's extremely difficult to try to identify those individuals, but is there going to be any type of initiative to try to identify those, to require them to, and their companies to pay employment taxes or income taxes here in the state?
Yeah, so we do have a physical presence test. If they do become more than 200 days, they become residents of this particular state. If they do pay Hawaii taxes, then I'm sure their particular state may have a credit against their particular taxes. That's not the big thing about remote workers. I think the companies that send remote workers to Hawaii doesn't realize that they're creating a nexus for these companies that's not in Hawaii. Now, do I have an initiative to go and get them at this particular point? No, and let me tell you why. There's kind of a conflict, because I think the Business and Economic Development DBED, what they're trying to do is attract remote workers. What I'm trying to do is tax remote workers. So we're still having a discussion on that. I know for a fact that the University of Hawaii is having a very, very difficult time. Hundreds of their workers are working remotely and hasn't been in the state for over a year. So I think that's going to become a huge issue currently. So Scott, no, we don't have an initiative at this particular time. And Scott, I don't really think it's a big dollar amount for us.
Great. Thank you, Director.
Director, you've also worked on improving the process, right? And also training your staff. Like you've trained your staff like on multi-state taxation, because for many years the department didn't do a lot of multi-state audits. And you also you're trying to monetize all of the cases in the pipeline, like at the Board of Review in Tax Appeal Court. Could you talk about that?
Yeah, Kurt, the little difference from when you were director here, you're going to be shocked that even my office auditors are doing schedules O and P, which is
They're doing a lot more sophisticated cases.
Yeah. And actually, and for you guys who are not familiar, our office auditors are probably our lower end auditors, whereas our field auditors take the bigger clients. But when our lower auditors starts doing multi-state taxation, allocation of income, imputing income via expenses, the office itself is getting pretty sophisticated. And yes, we are heavily in that area. And I think you'll be seeing a lot more cases in that particular regard. Actually, we have no choice if you really think about it, because as the big internet companies comes and takes over our landscape, the department has to be mobile and competent enough to enforce our laws.
Director Troy, this is Marilyn. I had a question. The IRS currently doesn't seem to be functioning as well as in the past because of understaffing and because many of them are working from home. If you try to deal with them, you oftentimes have to wait 2 to 4 hours to communicate with them. They also have not been processing a lot of the returns. They're delayed. And my question is, what effect does that have to the state taxes, as far as matching and and seeing whether the state is properly recording the proper amount of taxes when the federal government is so far behind.
Yeah, so I don't know if this is a secret, but as far as the data that we get directly from the Internal Revenue Service is pretty old, 2 years at least. And then we have 1 year left on statute. So we don't really rely on that. We have another avenue to get current data, it's called modernized e-file. As you practitioners know, as you guys e-file your returns, I can pull up your current returns almost immediately. I mean, seconds after you file, both your federal and your state. So we use that particular avenue a lot more. Also, I'm very, very fortunate that the governor kind of leaves me alone. There's a lot of pressure at the federal level to be a kinder, gentler IRS. Governor never ever told me that. So I'm not a kinder, gentler person, never have been. So he's really given me a free rein to, make sure that taxes are administered equitably and fairly, and to be aggressive. So I'm kind of glad that the leadership from the top is allowing me to protect the revenues of the state. Is there a hand up or something? Oh,
So we had a
okay.
question, I think, from Dr. Sidehouse and Carl, Dr. Bonham. Any,
I was just going to suggest, I appreciate the wide-ranging discussion. It's very useful, but I'm kind of concerned that we've got a tough forecast discussion ahead, and hopefully we can turn to the meat and potatoes.
any other questions of Director Char? Okay, thank you, Director Char.
Thank you.
Thank you.
Okay, Seth, I think you're going to do how long is your presentation? 10 minutes?
5-10 minutes, no.
Okay, good.
So, hello, everybody. Let me just share my screen with everybody. Does that look good to everybody? Okay, great. So just to let everybody know who's watching at home and who's not a council member, this will be posted on the internet by tomorrow. So everybody will have access to this information. Just doing things very quickly. Tomorrow, I believe we haven't reached the official preliminary out, but this is it essentially. You guys can see it. So the most important number that you guys will be concerned with is the 27 point, year to date, the general fund is up 27.6% revenues compared to last year. I've done a couple things here. One, you can see GET revenues are up 37.7%. I'll skip corporates because it's actually a very small portion of our revenue. Individual income is down or is flat on the year. Now, all of you guys will remember that we had the delayed tax payment in 2020 until July, which messed up our numbers a little bit. We pushed from one fiscal year into another. If we make that
that was about 300 million.
Yeah, it was 308 million.
Which is over 4%.
Yeah. So if we make that adjustment, individual income tax revenues would be up 23% on the year. Right. And of course, the other big thing that transient and accommodation taxes are very up, and nearly all of them are going to the general fund, which is unlike last year, right? So that's something to keep in mind. So all in all, we're up 27.6% on the year. If we adjusted for the individual income payment that occurred in the previous year, right, we're amending the denominator, we'd be up 40% on the year. I do want to bring to your attention, because this is a nice little absolute number that you can sink your teeth into. So we've collected about slightly more than $4.1 billion in revenue right here. Given the fact that we usually collect a little bit more revenue in the second half of the fiscal year, 8.4 would be, unless you think something is going to be different from the previous year, 8.4 would be a reasonable basically a continuation of the trend line, and that would be 16% annual growth.
8.4 billion.
Yeah, 8.4 billion would be around 16% growth. Mhm.
Which just happens to be roughly what Model 1 is predicting, I think.
So just to go really quickly, I wanted to show you how this is
fiscal
month
year?
over month of the
Can I-
previous year. So this is December, this would be like December 21 compared to December 20. And what you'll see is, you know, during the pandemic, it was down, we rebounded, this is mainly because of year over year comparisons when this was the biggest shutdown. You'll see this is the Delta variant. And then last year, because we're comparing to last year, but things have been holding up pretty well. So GET collections are, you know, in around the 30% range currently year over year. If we just looked at general fund, we're in that range, you know, for actually in the entirety of this fiscal year, we've been between 50 and, you know, 25%, with the one exception of July, which was affected by the late payment and that occurred in 2020. So
Dr.
these are
Kobe,
the ideas. Yeah.
How much more, what percentage more are we getting from the TAT on an annual basis?
On an annual basis, well, we're getting I would say $160 million more.
About 2 points?
Yeah.
A little more than 2 points?
Yeah. Mhm.
So Seth, I thought that in the December statement, which had fiscal year to date, it looked like TAT was up 300 million compared to year earlier. Maybe.
So let's look right here.
Oh, that was the total.
Yeah,
I'm
this
sorry.
is the total. This is 326 million. And unlike previous years where about half of that would have gone to special funds, or slightly less than half of that, all of that is now going to the general fund now, or nearly all of that is going to the general fund.
So if you look at the TAT row, and the difference cumulative is 291 million.
Yes.
So, but then when director asked you about the full fiscal year, I thought you had said 150 million.
Well, there was, what happened was we switched the TAT revenues used to be earmarked, one for the counties and two for the tourism and things. So the 180 million, I believe it's 180 million, around that that would have gone to special funds from this number is now going directly to the general fund. So like,
okay, I got it. Yeah.
You got it? Okay.
But that doesn't account for if there's an increase in the TAT, right? That's just based on the historical numbers.
Exactly. Mhm.
Okay.
Okay, and then I just wanted to remind you guys, this is your current forecast. So the current forecast is 6.3% and then 4% all the way across, right? So this is just a nice remember. And then, you know, as a Department of Taxation, we're trying to always make your job as the council members easier. So one of the ideas that I had, and we're always looking for more ideas, is this is a table of how your economic parameters affect Model 1, which seems to be the most seems to be the best reasonable model. Yeah, thank you very much, Carl. So what we did here is, I just wanted to show you, because this may help you guys in figuring out this shows the model. Now, there's three main things that affect the model. There's construction, there's visitor arrivals, and TPI growth. Those are the three main drivers. What we did was we used the construction revenues as, we used the mean forecast, and I just broke out two different parameters right here, right? So you can see how the model would predict the changes in general fund according to visitor arrivals, right? So I know you guys do it by percentages, but we also put it by visitor arrivals. So let's say if you guys really thought there would only be, or there would be 6.9 million visitors this year and negative 2% growth, TPI growth, the model would predict 12.4. But if you thought it was negative 2.0 TPI growth, but it was 7.9 million, it was actually 9.3. So I'm showing you this for two reasons. One, I wanted to show you the sensitivity of the model to these two, really the two most important parameters. And then you may find it helpful as you guys are making the discussion, say, if you guys agree that, you know, Carl, what is the current like forecast for the fiscal year, number of visitor arrivals for the current fiscal year?
Well, so actually, I'm glad you asked that question, because, you know, before the meetings, I look at what the mean inputs are from the council, and the council's mean input is about 6.9 million visitors. And I think if you were to look at DBED's numbers, I think DBED's numbers are probably more optimistic than ours. And so if I take my visitor arrivals, it's 7.9 million for the fiscal year. And so, and, you know, and we've been dealing with this for the last year, where every meeting, the forecast for visitor arrivals and other categories that the council is submitting is too low. And actually, UHERO's forecasts for visitors have been too low over almost this entire pandemic. I think our most recent forecast might be the first one that was too optimistic. So anyway, and then related to that, you know, when we did our TPI meeting, you know, we had a lot of discussion about the negative real income growth for next fiscal year. I guess this is the number here is this fiscal year, right?
Correct. This is for fiscal year 2022.
Okay, right. So, but the BEA just released revised income data, and they revised it up a lot. And so they revised the second quarter and the third quarter of, well, they released the third quarter number and they revised the second quarter number, and the revisions amount to 4 or 5% growth. I mean, it was a big upward revision. Some of that is technical mumbo jumbo that I don't think reflects real activity, but most of it is real economic activity. It's higher wages, frankly.
Okay, so yeah, I just wanted to share this table with you. This is table 8 in your packets. So all of you guys have this in your actual packets, and we're just trying new things that helps facilitate you guys. I know it's really difficult to come up with numbers given around that they move. So if something like this helps, or if you have other ideas, please let us know. We're happy to support you and you guys if you do this challenging task of figuring out the general fund forecast. But we're working on coming up with ideas that we're really gonna help you guys be more specific and narrow things down. And so that's it for my presentation. As you know, in the past, I can show that the Excel sheet of the general fund revenue forecast that allows you guys to play different things. I can bring that up and you can play with it. I do not have to, but that's what I got from you guys. And if any questions, I'm happy to answer as well.
Any questions of Dr. Kobe?
I have a question. What was the visitor arrival? You know, I think of calendar year instead of fiscal year. What was the visitor arrival numbers for last fiscal year?
I can look at that. It's in our.
That was
3.3 or so.
That's
3.3 million.
That's calendar year.
No,
20.
that's fiscal year.
Fiscal year
21.
21.
Fiscal year 21.
Fiscal year.
Yeah, fiscal year 21. And I did a short look on the website or on TPED's website, and I believe we've had about 4 million visitor arrivals to date for this fiscal year.
So we're over, we exceeded, or in 6 months, we exceeded what we had in the full 12 months the prior.
So to put some context on what we're seeing in the very near term, I guess I would characterize November and December as, well, they were weaker than we anticipated, but still, I don't know, in a meeting the other day, Eugene, Dr. Tian characterized them as positive. So so I was looking at the bookings this morning because I assumed that would be a topic of concern with the Omicron outbreak. And so far, going back to middle of December, I don't see any evidence of declining bookings, so that or cancellations, right? There may be cancellations, but they're being netted out by new bookings, and actually the bookings are surprisingly strong. So year over year growth in bookings, and this is mostly Oahu data that I have access to, which suggests to me that it's probably even stronger when you look at the whole state, because Oahu is so affected by the international market. And so the booking number, the growth rates year over year are, in the 300% range. And actually fairly surprising. Yeah, so 300% and 400% for January, February, and March compared to last year.
My concern is, I was wondering, if you go around on Maui, for example, there's a lot of, every single business just about is looking for workers, retail, restaurants, everywhere. And I hear that people are leaving, people have health problems because of, I guess, cancer, heart disease, or whatever. And I was wondering how this lack of workers in Hawaii will impact the revenue forecast that you have.
Are we talking about this year or longer term?
This year and longer term.
Yeah, so I mean, this year, the thing that's, I would suggest that it may be that the biggest impact of Omicron is on worker shortages. And so, yeah, that's an issue. But we got to remember that businesses have been dealing with this in one form or another, maybe not quite this severe, but they've been dealing with this now for almost 2 years. Right? The biggest drop in the labor force was, back at the start of the pandemic, and the labor force has actually been growing since the trough in April or May of 2020. And so businesses have already done a large amount of adjustment to this in terms of just changing the way they work. So you think about a restaurant that used to have waitresses and waiters that had specific tables. Now they're roving waitresses and waiters, so they have half the staff that they used to have, and so effectively it's actually showing up in higher productivity. For the same for a much smaller workforce, they're producing an enormous amount of output and income. So it's, I think it's something that they're adjusting to, and we're going to get through it. I don't think it's already built. So I would say in our forecast, it's built in. When we did our last forecast, we did scenarios, and the low scenario had almost no growth in the labor force at all. And the baseline had some recovery, and then the optimistic had more recovery. And frankly, no one really knows what's going to happen, how many people are going to come back into the workforce.
Yeah, I've seen people leave, recently. Because they were
Yeah.
stressed out, too much work in the last year. It was just too much, trying to deal with COVID, the thinking about the stress and overwork in their small businesses. So my concern is that we won't have the businesses recovering as we might expect, just because we have such a big labor shortage. And maybe that can be partially alleviated by raising prices, but then if you raise prices, then people won't go to the businesses as much because of the price. So I see this as a problem, just because if you just here, I'm not sure how it is in Oahu, I haven't been there recently, but there are just signs of everyone needing employees, including in the accounting industry. And so all along the line, there's too many vacancies that I see. I mean, people are looking for employees, can't find, and then the ones I see are moving out of state.
Dr. Kobe, thank you for the presentation. It looks like we've kind of just moved over into the general discussion of the the forecast for the current fiscal year 2022.
I think Jack had his hand up.
Yeah,
Jack?
I was going to suggest that it appeared that we had moved into item 5 on the agenda. And if
Yes.
that's the case, I just want to focus or start by talking about how my forecast assumptions led to a forecast in the model of Model 1 forecast of about 25% for this fiscal year, which obviously is very high and is due to the fact that we're dealing with a low base for most of the fiscal year. In what's driving my forecast is that I'm assuming about 20% decline in visitor arrivals relative to 2019 for the rest of the fiscal year. And that puts me at about 8.1 million visitors or so. And I've bumped up my inflation forecast somewhat. So my model is taking me to 25% for this fiscal year.
What do you have for inflation?
Oh, shoot. Let's see I can't remember exactly what let me see if I can find it.
So Jack, that percentage is consistent with the table that Seth showed.
Yeah,
right?
precisely.
Because
Yeah.
it's just simply based on the visitor arrivals forecast. You go to 8.1, that's going to get you pretty close to 25%.
Right.
This is
My
25%.
inflation number for fiscal 22 is 6%, and fiscal 23 is 4%. Both of those are higher than I had before. Frankly, if it's anything like we normally do, which is under forecast an upturn, I suspect that inflation numbers, maybe not in these particular order that I have it, but inflation is going to pick up.
So Dr. Sidehouse, are you saying that based on general fund of 7.2 million, it's going to grow by 25%?
7.2 billion. Yeah, I mean, that's what my forecast is telling me.
So we're going to hit over 9 billion.
I'm sorry, that's what my assumptions in the Model 1 are telling me.
So are you saying that we're going to exceed 9
And
billion?
we're at 27% now.
Yeah.
I don't think that will sustain 27%.
Because I mean,
So I think 25% is high.
okay. Because I mean,
But I'm just letting
year on
I'm
year,
just
we're
letting
comparing a very low period, right? Fiscal 20, the prior year was very low from like July to December because the Hawaii was shut down.
Well, yeah, no, of course.
Yeah.
Yeah. So I mean, there's a reason why it's 25%. It's a low base, but it's also relatively modest assumptions about visitors. 8.1 million is not. I don't think is out of the question for the fiscal year.
No, I don't disagree with you.
So before the meeting, I was working on updating our short-run visitor forecast and basically assuming that January and February and March are going to look a little bit like what happened with Delta in terms of the slowdown in arrivals. And that's inconsistent with the bookings data, right? So I'm way more pessimistic than what we're seeing in the bookings. And when I do that, I get a fiscal year arrivals of 7.9 million, not that far from what Jack had. So I guess what I'm getting at is that even with a fairly gloomy outlook on what Omicron might do in the very near term, you got to remember that there's bounce back and that it's Omicron's not going to be here for the next 12 months. Now we might get another variant. Nobody really knows. Maybe by end of summer there's going to be another wave. But what we're seeing right now is that U.S. visitors don't seem to care. They're traveling, and it doesn't seem to matter what's going on. So I think that I agree. I can't imagine us hitting 25%. I just don't think that coming out of my model with all my assumptions and with our own general fund tax forecast, I think we were coming up with 12 or 13%. And my numbers weren't quite as high so with my assumptions plugged into model 1, I think I was at 23%. I was a little bit below Jack's. My inflation forecast wasn't as high. Yeah, so looking at the results from the model that I run, I get 12.8% for the fiscal year.
I had a question for Seth, if you can answer the question. With respect to the taxation of the PPP funds, it wasn't determined until the last minute of the filing season in April that businesses were going to be taxed by the state on its PPP funds. How much of that PPP fund taxation fell into the current fiscal year versus the prior? Because the director is allowing everyone to amend the returns as of December 31st to allow them to record that income and recognize that income in the second half of the year for 2021, where it should have been reported in the prior fiscal year, in April. So my question is, how much of that income from the PPP funds fell into this fiscal year versus last?
Unfortunately, I don't have the data to sufficiently answer that question. We don't really have the opportunity to look at the tax returns usually until next year. And even then, at least my office, we haven't been able to answer that.
Did you put a revenue estimate on that provision when it was being completed?
Yeah, I can look that up for you guys.
Okay, Dr. Bonham.
So Marilyn said that she was talking about, so when the tax liability would happen, and I have a question about that. So so the way that the Bureau of Economic Analysis is accounting for this income appears to be, and I did some research on this, but I don't have a completely clear picture, but it seems to be when the loan is being forgiven, right? So there's because these were loans initially, but they're being counted as income because they really are being turned into grants. But they're not showing up in the income. So they're showing up in the income statistics now. So in the third quarter, there was about almost a.
So Dr. Bonham, Marilyn's actually talking about something else.
She's not. She's talking about the tax liability on the PPP loan.
Well, she's not talking about when it's forgiven. She's talking about.
No, I understand that, but that's the question. That's the question.
They're two separate items, Dr. Bonham. One is when you have the income. The other is when you could claim the deductions.
So you're asking about deductions. I thought you were saying that the PPP loans were going to be taxed.
Well, she's focused on the deduction aspect.
Okay.
Yeah.
So I just pulled it up. The deduction aspect was the expected loss, which we didn't get, right, would have been 253 million. However, that would have been taken over many different years because you can take the losses. So it would have for fiscal year 22, we only expected an $86 million loss if they were allowed to take all those deductions. So that's like slightly, that's 1%.
So what are you saying? It's 253 million that you estimated for the loss of for denying the deduction that was allowed for federal purposes. Is that what you're
If we
saying?
would have followed the federal, we would have expected an additional $253 million loss that people would have been able to take over multiple years, because most people wouldn't have been able to take all their losses in one year because they wouldn't have had the tax liability. So we extended it over several different years. If you are concerned with fiscal year 2022, what we thought is it would have been 86 million.
So I'm apparently completely confused. It sounds to me that you're talking about an estimate of a tax loss that would have happened if we followed federal law, but we didn't follow federal law, and so it doesn't affect us.
That's correct.
No, the revenues came in probably in the second half of 2021. A lot of it because
What people did was a lot of people claimed the deduction in anticipation Hawaii would conform. But Isaac ran this program where he tried to collect the money by the end of last year.
Okay, that helps to clarify why we're talking about this.
Yeah.
But so if somebody took a PPP loan and they didn't claim a deduction, okay, and the loan turns into a grant as they are they paying tax on that? They are, right?
Well, they don't pay income and general
not
excise on the
recognizing the
loan.
income.
Yeah, there's no tax on it.
So if a business gets a grant from the federal government, they don't pay tax on that.
Correct.
Yeah, generally. But what people, this was kind of an extraordinary loan where Congress allowed people to double dip or triple dip so they could claim a
Not that way.
deduction. Yeah.
No, I understand that. Yeah.
So
So actually, federal law said that they wouldn't have to pay tax on it, but they could claim a deduction. That was the
Yes,
double
yes,
dipping, right? Yeah,
yes.
okay. I think I'm clear.
And so Hawaii says Hawaii tax law, says you do not have to pay income tax on it or GET on that. However, you're not allowed to take a deduction against the losses associated.
In other words, the money that you spent, you can't claim as a deduction.
Just to
But
bring things
basically-
back, like really, you guys, this is $50 million in terms of what you guys are trying to estimate. It's nothing. I mean, to be perfectly honest, like
actually, the practitioners thought that it was going to be allowed as a deduction. So people will have to scramble after the year end, after June, and try to incorporate that additional income into their returns. So the revenue would have followed.
So you mean revenue will go up because they were
Yeah.
using a deduction that no longer exists.
Yes,
Correct.
you're right. So Dr. Bonham, you had mentioned your bottom line number was 12.8 growth rate.
Yeah, from my model, in the council's model, model 1 from my assumptions generates 23.8.
So it translates to 12.8 as a general fund growth rate.
In the model that I run, that's correct.
Which is separate, which is different from our model 1.
That's right.
That model does include the tax adjustments. The below the line.
No, I mean, you mean below the line stuff?
Yeah.
No,
Whose model are we talking about here?
Carl's,
Carl's.
he was asking me.
his homegrown model.
Okay, got it.
So further discussion? What do you guys think about 12.8?
I think it's too low.
What do you think it should be, Dr. Sidor?
I don't know yet. I haven't heard what other people have to say.
Well, if you look at table 6AA, if you're looking at above the line, it's 12.9, 21.9, and below after the tax adjustment, it ends up being 16.4 for the growth rate. Is that right?
Marilyn, where are you looking?
Page 13.
Page 13, table 6AA.
just as a reminder, you guys are predicting the bottom below the line adjustment, right? So
Right.
16.4 is what you guys would be predicting. If you wanted to follow, if you just wanted to follow the mean of the model and you guys chose 16.4, that's the one you should do. It's not the 21.9%.
I can
Right.
live with that.
16.4.
Yeah.
Okay, do you want to make a motion?
Well, I had a my
Well,
model. Yeah, I liked his 12.8. Dr. Bonham.
Yeah,
And if
well,
he
that's
said-
what you
and if
might
he's-
get it. Go ahead, Jack.
No, I'm better off not.
You know, when I look at the council's inputs, you know, I think the income input is too low, particularly given the revisions that we have seen from BEA, which included third quarter of 2021. And what I think is a visitor arrivals forecast, which is way too low. I mean, the council's mean forecast for visitor spending, I'd say, is off by $1 billion. It's just too low. And, you know, and visitor spending has grown faster than arrivals. So, you know,
How much is it grown?
But Carl, aren't you taking that into account in your model?
sure. Yeah, so, I mean, so actually, if you were, so if we were going to practice reasonable methodology, we would, if you have some kind of faith that we should be using numbers from my model, we ought to average the two. We ought to average model 1 and my model, and we'd come up with a number, you know,
14?
14 and a half.
That's close
Well,
to my number.
But you're putting in different assumptions to both of those models, right?
No, well, no, I mean, the assumptions that, so yes, the model 1 results for the council are different from the results that come out of my model. But that's, I mean, that's okay. You know, model averaging is actually, I remember going to a seminar that Jack hosted 10 years ago on model averaging as a strategy.
Yeah,
The-
seems to be
Okay.
quite popular.
What is your estimate for inflation?
For was that a question to me?
Yes.
Let
Up
me
to start out,
see.
say 6% from his perspective.
I think mine was, oh, 1 second.
Well, Carl's looking that up. I know 15 seems like or 14 or all these seems really, really high, but just a reminder, in 2012, it increased by 15% in 1 year, and the recession was much more the recovery was much more subdued than what we were seeing. So I know 15 makes everybody feel really uncomfortable, but in recovering from recessions, that is not out of the range of what we're seeing.
Yeah.
Well, I think the thing, one significant factor we have here too is we have a much larger inflation factor.
Yeah, 5.4%.
Yeah.
For the fiscal year is the latest inflation number that came out of the model. And yeah, and those inflation numbers make a big difference. I don't think Seth didn't do a table of that probably, but they matter.
Mhm.
Councilmember Hayashi, do you have any comments?
You're muted, Scott.
Sure.
Sorry about that. You think I'd learn by now. No, so I would agree that in my model, yeah, the visitor arrivals, I had much higher number, closer to 8 million. And same with visitor spending. I was closer to what Carl said, closer to 11 billion there. So yes, I think, you know, the number seems, you know, 14 might be a little low. And I think, you know, 15, 16 where we're at, I think that makes sense to me.
Councilmember Lee, do you have any comments?
Yeah, you know, if you look at you know, we can push around all kinds of numbers, but if you look at what the mean means to the council, what we've all done, you know, we get to the 16.4, and with the higher inflation, it makes sense that we can go higher. I've been just flabbergasted by the visitors just keep coming. And when you talk to many of my friends who have made it back home, in their minds, COVID is done. It's pow. They're moving on, they're living on, and they're just flabbergasted. Hawaii is so behind, and they're going to just keep coming until the world opens up. And so that's not going to be for another year or so. And so I think we're going to see a big increase. So I'm comfortable with 16.4.
I'll make a motion for 16. I think it's 16.1, isn't it?
Oh,
Well, can I say
16.1, sorry. Yeah.
one more thing? You know, this model that we have here, I'm looking at that, but these numbers are the amounts that are above the line in table 6AA. It's not the below the line numbers, which is quite a bit, like 5% lower. So the tax adjustments are going to be about 5% lower than what we have in our models. You see what I'm saying?
Table 6AA, the below the line number is 16.4%.
Right.
That's what,
Well, what I'm saying is the number that you're looking at that we have in our model 1 is not, I think it's the above the line figures that we're getting, because that's an economic factor. It's
Right.
not the tax
No.
basis. So on this model 1 that came through, it would have been 16.3 above the line, where right now it's showing 21.9.
That is incorrect. Our
Yeah.
models account for that, right? So what our models are saying, it would normally be 21.9, but because of all these adjustments, it'll be 16.4.
Correct. So
so
the
model
number-
1 on page 11, Marilyn, is just reporting the below the line
Yeah.
number.
this is below the 9. Is that what you're saying?
So on page
Yes.
11, where it reports the model results, it's reporting the below the line number. And then on page 13, table 6AA, it's just showing you both the above the line and the adjustments to get to the below the line.
Well, I didn't recall putting into my equation the numbers for the tax adjustments.
You don't put them in,
You
they're not
don't.
yours.
It's
They're
the
not
department
yours.
that does that. In other words, if your forecast had come out at 16.4, I'm sorry, 21.9, it would have been adjusted to 16.4 by the department.
Right.
So all of our, you know, we all get a table that shows our forecasts, right, resulting from our inputs. Those have all been adjusted by the same below the line adjustments. Right, our inputs generate a different above the line, and then the reported numbers are the below the line.
For example, when I talked about my 25% forecast for 2022, that's a below the line number.
Okay.
So,
Councilmember Miner, do you have any comments?
I'm always a little hesitant to be too optimistic on these forecasts. Certainly, the numbers have been just incredibly strong. So that's very good news. I think next year, half of the year, perhaps it's a harder comparison as far as the percentage change year over year. I would feel a little bit better averaging Carl's good numbers. I believe he looks at those very carefully with the council's 16.4 to come up somewhere in between.
So you would average 12.8 and 16.4?
I'd even say 15.
Hey, my number is 14.8.
Oh, okay.
Oh, you've been holding back on us, Mayor.
you know, I'm sure that's way too high. It can't possibly go that high.
No, I looked at that, I said, what? This equation is, whatever this equation is coming out to is coming out too high.
So it
Yeah, but
sounds,
let's remember that we're halfway through the year and it's 27.
Yeah.
Yeah.
So
got half of it already. Yeah.
But I don't think we're
We
gonna
also had
get,
that big bump, right? We had that
Yeah.
real big bump, 300 million in the, from July.
that's a
Oh,
negative.
that was last
Oh, no,
year.
that's not true. That's not true.
That was last year.
Because that's fiscal 21, right? Fiscal
No.
21, the prior fiscal year. in
Well,
July
yeah, it wasn't, yeah,
July
it
of
was July,
2020.
it was July 21,
20, which is fiscal 21,
right.
had
So,
that 300 million more in June.
right, and so that increases the base. We're talking about
no,
fiscal
but-
22.
Yeah, you're
If-
right.
Yeah,
Yeah, but we may be hard put to reach the $1 billion that we did last April, right? That's what I'm thinking of year over year comparisons.
well, Seth gave us that Excel table.
Right.
Would you guys like me to bring that up or not?
I don't know if we need to. I think we're
Okay.
getting close to
Well,
this.
I just want to call our attention to the fact that that one's coming in at about 15.5, 16%. And that assumes 20% growth for the first couple of months and the rest of the fiscal year. And then a significant decline and slowdown for the last 3 months of the fiscal year. And that still comes up to more than 15%.
Yeah, he's got a 10% drop in April.
Right.
And then thereafter it's 4%, which is probably too low given the 5+% inflation.
And just to let you know, I updated the December numbers with the more accurate one. So I moved it up. That was another 50 million that I was anticipating. So it actually went up another % when I put in this month's numbers.
So that specific spreadsheet is now about 16.5.
16.2 if we assume it's 20% for the next January, February, March, minus 10 in April, and then 4 and 4 in May and June.
Yeah, my concern is that if you look at April, we went up way high,
Yeah.
as far as the income. And my concern is that we're not going to repeat the April collections compared to last year. I mean, last year we had a lot of stimulus funds.
That's
uh,
No,
Well,
because it was deferred. The prior year was deferred to July, right?
Yeah, but we
But
have a
this
lot.
last April, we had a record high
Yeah.
collections. It hit,
Part of it's because we were getting a lot of payments that had in the prior year been postponed to July. Because that's when COVID started. The tax department moved the deadline from April to July in 2020.
No, but the collections wasn't in April.
But this is 2021,
2021.
2021.
Yeah.
April 2021.
That was a surprise. And, there was a
But
lot of.
that's why April 2021 was very high. Because it was
20
off of a low base.
2020 income collections.
No,
was
it's
very-
absolute. We're talking about a really absolute number that's really high.
Right.
And that's why Seth has a significant decline in assumption for his April calculation. And
So
he's
I
still coming in at over 16%.
Yeah, but the April one was really, it really went up. And I'm not sure that that's going to be repeated again. Because
And that's
I'm
why,
willing to bet you're going to be surprised.
the income from this year, from 2020. The
All those
only-
people who were deducting PPP loans, who suddenly just found out they can't.
They paid me in December.
The only thing that would make the income go up, in my opinion, is probably the capital gains. I see people coming in, I'm selling this property, I'm selling this property. They're paying twice as much for my property as the value before. So there's going to be some of that capital gains coming in due to the sales of real estate. That's what I think, but then from the income tax point, I don't think we have as much of the stimulus money coming in to help businesses. We're gonna, the federal government, that money is gone and
So-
everybody's looking around for more money. And
So Marilyn, so in the only data we have for this fiscal year from total income. And actually I'm looking at labor earnings, right? Wages and salaries, not transfer payments or anything. In the third quarter, the data just came out, it's 13% growth over the previous year. So the income that we have so far for this fiscal year is growing at more than 10%.
Seth, Dr. Kobe, can I ask a question? So for 2020, unemployment earnings were not taxable. Is that correct? In 2021, they are taxable. Is that right?
Unemployment earnings have always been taxable in
Oh,
Hawaii.
they were. Okay.
Yeah.
Okay. Well, it's just on the federal side. Got it.
So are we
Okay.
talking about a difference between 15% versus 16.4? Is that what we're talking about?
Yeah, let's just average it and move
I
on.
mean, I think, yeah. What about an
Remember,
average?
I would
I thought I made a
wanna-
motion.
Yeah,
I
well,
think
yeah,
we were
no.
stopped in the middle of it, Carl, but I do want to point out that I'm just looking at general fund collection. We go back to 2019 in April, it was only 800,000 versus $1 billion this last year. And if you go back to 2018, it was 600,000. So even
600 million.
600 million, thank you. I'm talking millions. So even a 10% decrease may be not enough. So I'm just throwing that out there.
Yeah,
So
a
if you-
billion is
If
remarkable.
you
for
change
one.
it, if you change it to a 20% decrease, I get 15%, 14.9.
Hey,
So
closer
I
to my
think-
number.
That's
I
okay.
think 15% is a good number.
How do you guys
You
feel
should
about
make a motion.
I'll make a motion
See,
to that effect. And
I-
it's still a good number, I think.
I second the
second.
one
motion.
little over a point difference?
I second the motion at the 15.
Was your motion seconded, Carl?
I don't think so.
Okay, okay, so there's a motion that's been seconded at 15%. Vice Chair Newell,
Well, can we discuss it anymore?
oh,
or-
you want to discuss it further?
Well, I don't know.
Because we're
I'm
one-
asking, I'm
one-
asking people. I mean, I think 15 is too low, but you know,
I mean,
and I may not vote for it.
Normally, after I make a motion and it gets seconded, we discuss it for 30 or 40 minutes. So
if you want to discuss it,
That's it, yeah.
further.
Well, who's not comfortable with 15? I mean, I think 15 is on the low end.
I think 15 probably is going to get all the votes. I don't know about you, Jack, but
I think you're right, Jack. I mean, I agree.
But
Yeah,
you're going to throw me under the bus anyway.
Well, I mean, you have been known to abstain.
No, I've been known to say no.
yeah, you have on occasion.
I mean, how many people are in favor of 16? I mean, I kind of with Jack that I think it's higher. And a point makes a difference.
I think we might actually have the votes for 16.
Well, I
You
think
might
that
have,
we have
it'll be a
to-
split vote at 16.
Yeah,
Or it'll
we-
be,
we have a-
it's possibly going, I don't know what Jack's going to vote, but it may be unanimous at 15.
So doesn't Seth get
Carl-
to vote if we have a tie?
Hey, Carl, but
We have
You
7
know-
members.
if I could just advocate, I mean, Carl, your own model says 12.8.
Yeah, that's true.
Yeah.
I don't
that's
want to
true.
throw it at your face, but
But yeah, we still have a supply chain problem. We still have, the Fed saying that they're going to raise the interest rate. And I think that because we have all these factors coming in, I would be uncomfortable with going, higher with the higher figures, because I think that the Feds are going to try to.
Are we seriously arguing about 15 versus 16? really?
Yes, that's why I was going to put it to a vote.
Well, put it to a vote.
Okay. Okay, Vice Chair Newell,
Yes,
Dr. Siderhout,
No.
Dr. Bonham,
do you believe in yourself,
Yes.
Carl?
okay, yes. Okay, Councilmember Maynard,
Yes.
Councilmember Hayashi,
Yes.
Councilmember Lee.
I'm a no.
Okay, so it carries by 5-2. Okay, we ended up with a split voting over 1 point. Okay, next item on the agenda is the general fund forecast for fiscal year 2023. Seth, do you want to kind of maybe lead, what's the model showing that we're gonna be in fiscal 2023?
The model says 6.9.
I'm actually coming in at 5.5.
Oh, you coming in low? So you have a higher.
Well,
Apparently,
His forecast for 2020, for fiscal 2022 is higher. Of course, he's coming in lower
Yeah,
on
account for
the
that.
growth rates. This is just the council means catching up to reality. That's why it's got to be 6.9, because we missed it in 2022.
Yeah.
I moved 6.9 for 2023.
I second.
Any discussion? 6.9 fiscal 2023. I have a question for Dr. Saddle and Dr. Bonham. What do you expect inflation to be in fiscal 2023? I think you said something like 4%, Dr. Saddle.
I think my forecast, hang on a second. Yeah, I assumed 4%. I
Dr.
think,
Bonham? Oh, go ahead.
I actually have 4%, followed by 3.5, followed by 2 3/4.
I have 4, 3.5, 3.5, 2.5.
But you don't think inflation is a problem?
Oh, I do.
Yeah.
I think 4%, twice the amount that the Fed is comfortable with.
Yeah, I think that they're going to put a brake on that interest, the inflation, or try
And
to.
being a state retiree, I'm very sensitive to 2.5% increments that are not compounding.
Yeah, the inflation rate with them passing all these bills that have deficit spending would be detrimental to retirees, I assume.
Well, that's my knee-jerk reaction.
Yeah, that's true. So,
there's a motion pending. Any further discussion? It's 6.9, right? Did you-
Yes, yes.
Any further discussion?
Carl, what does your
I'm comfortable with that.
what does your model show?
You
I'm
you
not
can
gonna
lie
tell-
about it.
I'm comfortable with 6.9.
I see, but your model is showing something much lower.
I do have a lower forecast having said that, I actually think our forecast is too pessimistic. And for the reasons I was talking about earlier, we have, and this was actually, it's consistent with what Wendell was saying. It's clear that US visitors don't care about, well, that's too strong. I'm sure there's somebody in the press watching, and I'll get quoted badly. But people are over. The travelers are largely.
There's all 3
over-
newspapers here, Carl, so good, congratulations.
So, I just think we're sort of overreacting to the effects of Omicron on the economy. I do think that the higher inflation, while it is a problem for households on fixed incomes, wages have accelerated pretty significantly, particularly
Really quickly.
in food service and in retail, and all of that. And right now the visitors are paying much higher prices, and that's all generating tax revenue.
yeah,
So I am comfortable with 6.9.
well, the inflation rate, yeah.
Are you willing to share what your model shows? Or are you keeping that a secret?
My Model 1,
No, your model, your personal model.
it's much lower. It's 4%. But if you shift the whole thing by what we chose for the first year, it's about right on track. Right, my model was lower for the first year also.
What
I
is your,
certainly
well,
would-
Christie, what does your model show? What
My
is your
model-
one?
my model is even higher, so.
There you go.
Oh, you're above 6.9, Christie.
But I don't know how much I trust the model, so that
So-
is that. But
So
I do think that overall, in general, the economy is going to do well. I think we keep thinking that COVID is going to go away, and then we get wave after wave of things, but the economy keeps going on, and I am optimistic about the travel industry, people coming back, people getting good jobs. I am worried, as Marilyn pointed out, of the people leaving the state. That's not a good sign. But it certainly does seem, especially US visitors are just coming in droves. And that's very, very promising. Certainly the international visitors are not coming. And you can kind of see why, in a lot of ways, some of these countries shut down and you could be stuck in Hawaii. Doesn't sound too bad, but I know of several people who got stuck in a foreign country when things got shut down. So it's,
Yeah, and
and
that's
they
scary.
couldn't get out. So there are reasons why people are not traveling internationally.
Jack and Carl, what are the chances of a recession in fiscal 2023? Like, for example, if the Fed increases the interest rates and there's a.
Well, there's no if about the increase.
Yeah.
You know, they are going to increase rates.
Yeah.
And the question is, how much will that affect, for instance, the equity markets and consumer confidence and that sort of thing.
Mhm.
And
So
I
let's put it this
don't
way.
know.
I haven't seen anyone, any forecaster, any market analyst yet starting to talk about a recession in the end of 2022 or beginning of 2023. I think that's really premature. The Fed has a long ways to go for moving interest rates to really start to bite. I mean, we're only talking about 3/4 of a basis point, so probably 100 basis points in market rates, this year. And we've seen a lot of it already, right? We've already seen probably 20, 25 basis points move in the 10-year bond. Maybe it's only 20 basis points. So, and put that in comparison, that isn't even, that gets us back to like not even 2019 levels, I don't think. 2.5. I mean, we're still talking about 3.5, high threes on a mortgage rate. Those just, these aren't enough to cause recessions.
My question is, have you considered that there might be international factors playing into our Hawaii economy? I guess because of the threats of war, Taiwan and China, and all that into our forecast long term. Because I've read a lot of reports saying that we should expect something within the next few years. And I wasn't quite sure whether we can look back and think everything is going to be the same as it was. We do have other, challenges. We have people hacking into our computer systems, and we have, there's a lot of challenges right now. We have climate change issues. We have cyber attacks. We have, there's a lot of things that I think in the past, we've been kind of assuming everything goes hunky-dory the same way it's been.
No, I don't think so. I think we recognize that, that these risks exist. The question is, how do you include that in a forecast that we're statutorily required to make? And, generally the way we do it is by tempering our long-term forecasts. And, and what are you thinking about for 23, fiscal 23, which is not, not long-term anymore?
Well,
So what's your forecast, Marilyn? Tell us your Model 1 forecast.
I was at 5.5. I'd be happier with 4. But that,
You'd be
things,
happier with
I don't-
3.
I don't consider, those things, but I see the danger and the risks, and all these things are coming through, and it's becoming louder and louder. The message is coming louder and louder. We have risks that we're not looking at, and we're talking about normalcy and continuing on as if everything is going to be the same. But there are other variants coming out. One from Cameroon, Africa. And so I'm not sure what will happen with these viruses because of the variants, and there's so many things. But I certainly am aware that we have a problem with cybersecurity. I do understand that. I'm not sure what the state tax department plans if suddenly we don't have the internet. But so those things are my questions, is that we haven't really factored in all these events in our forecast.
So I think Jack is right on the money that obviously you're not going to say, okay, fiscal year 2023, that's when the war starts and nobody travels to Hawaii, right? That's not the way we do things, but you do temper the long-term outlook more so because of things that are very, very certain, such as climate change, right? We know climate change, and actually maybe now that includes COVID, right? That it really is going to be around forever, and it's going to impose costs on businesses, and it's going to impose costs on households and travelers, and so it's going to make it essentially more difficult and a little bit more costly to do what we used to do, and so that has an impact on our growth rates long term. And how big is it? Pretty small, right? I mean, most of these things, climate change maybe not, but most of these things on a long-term basis, you think about if you think a steady state growth rate of tax revenues now at, let's just throw out 4%, I think that's our current long-run forecast. If you took into account the known risks that were reasonably certain, maybe you lower your forecast by 0.1%. And in some year, things are going to be much worse, and then you're going to bounce back, but it's going to average out to whatever that long run forecast is, and that's sort of the best we can do. And I don't think I don't consider the global the geopolitical risk to be all that different today than it has been over any other decade, right? Where maybe it's more in Asia, more in the Pacific than it has been in the past, but I certainly, we're not adjusting our forecasts out of concerns about geopolitical risk.
We vote.
Well,
Um,
I think that we should be considering something like that.
Well, we're still talking fiscal 23. Let's remind ourselves of that.
Okay, so maybe 2024 would be a better year.
That's the year when
The war.
we have the next war.
That's it, about 5 years, right?
So keep in mind that there's a potential for positive side effects from
Oh
wars.
God, don't think.
Unfortunately, it happens. Yeah, economies do better.
So
We got better.
It's not better. We're talking about dollars
Talking
and
about tax
cents. I mean,
revenue.
if you have an Asian threat, military dollars will more than flow into our sector that's been going to another sector. So there's pros and cons to everything.
I think we have a motion and a second.
yeah, I think we've discussed it. Anyone want to discuss it further? Okay.
So what's the motion? 6.9?
The motion is 6.9.
Okay.
An awfully specific number.
Yeah,
It comes out of the model, and technically it should be higher because we lowered this fiscal year's model forecast. I mean, just to be clear, right?
No, I feel comfortable with it because we went lower for the previous year, and then I was a little lower for the next year, but with that 1%, it hits it right on target. So that's why I'm okay with 6.9.
When do we When do we reconsider again? Seth?
March.
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 March,
I think it's roughly the mid-March, like March 10th, somewhere around there.
yeah.
Seth, do you know when the report, so it's not that, it's like 2 months away, roughly a little more than 2 months away.
Yeah, it's March 10th or March 15th. I can look right now.
Yeah. Okay, Councilmember Hayashi, any comments?
No, I mean, I agree with the 6.9. I think, you know, the economy is showing strength, and, you know, once again, the visitor numbers are rebounding. And right now, the numbers we're looking at don't even include international visitors. I saw something that forecasted that we could be at 10 million visitors again by 2024. So, you know,
That'd be soon.
as it's coming up, you know, the economy seems to be chugging along very well. So yeah, that's why I think, you know, I think that's a good number.
Seth, did you find the next reporting date?
March 15th.
March 15th. Okay, I'm going to take the vote at 6.9 for fiscal year 2023. Vice Chairman Niwao,
Okay, I'll go, yes.
Dr. Siderhout,
Aye.
Dr. Bonham,
Yes.
Councilmember Maynard,
Yes,
Councilmember Hayashi,
Yes.
Councilmember Lee.
Yes.
Okay, so it's unanimous. The council estimates 6.9 for fiscal year 2023. Okay, next item will be the discussion of all the out years, fiscal 24 to 28.
it's always
Well-
harder to predict that far in the future. I am projecting that inflation comes down. So I would feel comfortable staying at, where are we right now, 4% for that?
Yeah, we're at 4% for all the out years.
Yeah,
Make a motion.
I so move.
I
so
second.
second.
Okay. Anyone want to discuss it? I think everyone's all shocked at this point. So I'm
Too
going to take a
far
vote.
out.
We're tired.
I know. Okay, we're going to vote at keeping our forecast the same for the out years for fiscal year 2024 to 2028. It's 4%, Dr. Kobe, 4% each year.
4%.
It's 4% for,
Yes.
yeah, each
That's
of
my
the,
motion. My motion
Okay.
is at 4%. Thank you.
okay, it's been seconded. So I'm going to take a vote. Vice Chair Niwa,
Yes,
Dr. Siderhout,
Yes.
Dr. Bonham,
Yes.
Councilmember Maynard,
Yes,
Councilmember Hayashi,
Yes.
Councilmember Lee.
Yes.
Okay, carries unanimously. Okay, next item on the agenda is report by BNF, Mr. Chen.
are you there, Donovan?
Sorry,
I-
Yes, I'm here.
Yes,
I didn't fall asleep.
Are you sure?
No, it's too exciting. Good afternoon, Chair and council members. My name is Donovan Chun, and I'm with the Department of Budget and Finance. We have provided you with a report of revised projections of general fund non-tax revenues, non-general fund tax and non-tax revenues since our last report to you on September 7th. The revenue estimates were prepared by departments in November and were based on point-in-time assumptions made by programs and department staff. Our report includes a summary of the significant changes. I'll keep this really brief. There were a few items that kind of unusual. On table 2A under general fund non-tax revenues, under charges for current services, there's net increases in fiscal year 24 and 25. These are attributed to anticipated collections for reimbursements for other post-employment benefits from the non-general funded programs to reflect the reinstatement of the OPEB payments starting in fiscal year 24. Those were temporarily suspended by Act 229 during the last session, and those will sunset after fiscal year 23. And so those are reimbursements to the general fund from non-general funded programs. That's about 79 million. One other item, well, general items. Federal grants under table 5A, other than special fund non-tax revenues. The federal grants, there's a net increase in fiscal years 22 through 28. And these are primarily projected increases in medical assistance payments to the healthcare payments program at DHS. And then there's also the continuation of federal COVID funds flowing in. Some of these came in more, the official numbers came in more recent, so departments have added those onto their reporting. And then there's on that same page, under non-revenue receipts, there's an increase in fiscal year 22. And that primarily reflects the state making its annual required contributions for other post-employment benefit contributions. Those were suspended temporarily by emergency order, but with the improvement in the financial situation of the state, they went ahead and made that payment, which was booked in fiscal year 22. That was like $390 million. That's to make sure that Jack keeps getting his health fund. And that's it.
Thank you, Mr. Chun. Are there any questions of Mr. Chun?
I think it's interesting. When you look at the first page of this, we're talking about a total of what is 17, 18 billion. So everything we talked about with Donovan is twice the size of what we've been doing with the tax revenues. But you don't get twice the time, Donovan.
No, I don't need.
Okay, is there a motion to adopt Mr. Donovan Chun's report, BNF's report?
So moved.
Okay, second, any second?
Second,
Okay, I'm not sure who was first. Dr. Kobe, did you see who was first to second?
sound like
No,
somebody
can you-
beat me. So whoever was first.
Who was the other person? Just so we have for the record.
I said,
Okay, so it was Marilyn and Noah. A second.
Okay.
Thank you.
So vote to adopt BNF's report. Vice Chair Newell,
yes,
Dr. Siderov,
Yes.
Dr. Bonham?
Yes.
Yes. Councilmember Maynard,
Yes,
Councilmember Hayashi,
Yes.
Councilmember Lee.
Yes,
So the report is approved by unanimous vote. So the next item on the agenda is the scheduling the next general fund meeting. And the report date is March 15th, right, Dr. Kobe, which is a Tuesday.
Correct.
So how does the previous Thursday afternoon sound for everyone? That would be March the 10th. Is that okay?
Works for me.
I'm good.
Okay, March the 10th at 2 o'clock? Is
Yes.
everyone okay?
Yep.
Okay. So the next general fund meeting will be Thursday, March 10th at 2 p.m. Okay, that concludes the meeting unless there's any other items. Any other items? Okay, well, okay, thank you very much, everyone. Thank you, Dr. Kobe. Thank you, Director Choi, for your presentation, and Happy New Year again to everyone, and best
Happy
wishes.
New Year, everyone.
Happy New
New Year. Thank you.
thanks.
Here's to
Aye.
everyone.
Okay,
Take
bye.
care.
Bye.
Bye.